Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. In the earlier sessions related to the head of income from house property, we discussed section 22, which was charging section, and then 23, which is related to computation of annual value of the property, 24A and B, which are deductions from the annual value of the property, then 25B, 25 itself is about disallowances, and 25A related to collection of unrealized rent now or arrears of rent now when there was a past deduction given in the form of unrealized rent from the actual rent received or receivable, which is collected now, that shall be deemed to be the income of the SASI, irrespective of whether that SASI is still the owner of the property or not. Same logic applies to arrears of rent also, but both of them are subject to a 30% flat deduction. Remaining amount shall become taxable in the hands of the SASI. As far as the topics of this chapter are concerned, this head of income are concerned, only there are two things remaining. One is the deemed ownership, second one is co-ownership. But before going to them, let us quickly go through the answers for the task that has been given to you, which is there in front of you now, where in each case, particularly related to question number 1, we need to find out the gross annual value of the property. So how to do that? Thought process has to be very clear. Listen to it and also observe it very carefully. Municipal value and fair rent, whichever is higher, has to be taken. Then that and standard rent, whichever is lower, has to be taken. That means expected rent itself is 500 in this case. ARR, actual rent received or receivable, will be 900 minus 50 because unrealized rent is there, 850. Because 850 is already higher than expected rent, automatically 850 will become gross annual value. Then house property 2. Municipal value, fair rent, whichever is higher, 1000. That compared with standard rent, whichever is lower, so 600. That compared with 500. And ARR here is less than the expected rent, 600. But is it due to vacancy? Is there any question or point about vacancy? No. That means exception will not apply. Expected rent or ARR, whichever is higher, automatically will become the gross annual value. That's why 600 is the answer for house property 2. House property 3 also same logic. Municipal value or fair rent, whichever is higher. That and standard rent, whichever is lower, that means 900 now becomes the expected rent. Compare that with ARR, that is 800, which is less than expected rent. Is it due to vacancy? No, no mention of vacancy, so exception does not apply, which means automatically expected rent or ARR, whichever is higher, becomes gross annual value. That means 900 becomes the gross annual value in that case. That is the answer for question number 1. Then question number 2. Same thing. We have to still find out gross annual value only. One by one, let us look at that. House property 1. Municipal value 1000, fair rent 1200, whichever is higher, so 1200 has to be taken. 1200 and 1500 standard rent, whichever is lower, so 1200 itself will become expected rent. Now actual rent receivable is given as 1000. I think some of you have misinterpreted it as annual rent. No, there was no mention of annual rent. It was actual rent receivable. Let us say 1000 rupees is the actual rent receivable when the property was vacant for 6 months. Naturally, this actual rent of 1000 rupees will be for the remaining 6 months. Rent will be received only when there is no vacancy. So actual rent receivable 1000 means that is for a period of 6 months only, not for the entire year. This is actual rent, not annual rent. Nobody said it is annual. It was actual rent that is receivable. When a rent will be receivable? When the property is not vacant. So this 1000 is representing the rent for only 6 months. That's all. That interpretation has to be done correctly. Now after that, let us come back to the computation aspect. So where are we? Expected rent related to this particular property will be how much? 1000 or 1200, whichever is higher. 1200 or 1500, whichever is lower. So definitely 1200 is the expected rent. Okay, fine. That has to be compared with ARR. Now, ARR has to be just calculated as it is. 1000 is the actual rent receivable. 1000, fine. So, actual rent received or receivable is 1000. That's it. There is no unrealized rent and all. Whichever is lower in these two, 1000 is lower. Why is it lower? If ARR is lower than expected rent, then only you should ask this question. Why is it lower? Is it due to vacancy? Answer is yes. How do we know, sir? Because if the vacancy was not there of 6 months, the ARR would have been, we don't have to take it, but we have to just compute it, would have been 2000, which would have been higher than expected rent. But because of vacancy only, ARR is lower than expected rent. That means ARR should be taken as gross annual value. So 1000 is the answer for first house property, gross annual value. Then house property 2, same logic, 1000 or 1500, 1500, 1500 or 1800, 1500 only, whichever is lower. Now once again, ARR is 1000, ARR is lower than expected rent. In this case, expected rent is 1000, sorry. Expected rent was 1500 in this case. ARR is always 1000, same thing. It was 1000 only. It is lower than expected rent. But is it due to vacancy? That we have to find out. How do we know that? We have to find out given according to the vacancy period. Again, we have to understand this 1000 is for how many months ARR? Naturally for the months where the property is let out, that is 10 months. If the rent is 1000 for 10 months, how much it would have been for 12 months? 10 months, 1000 means 12 months, it would have been 1200 only. Would have been. Means, even if there was no vacancy also, the property would have had the actual rent receivable lesser than expected rent only. So that means exception is not applicable. Exception is applicable only when ARR is less than expected rent due to vacancy. Yes, ARR is less than expected rent here also, but it is not due to vacancy. How do we know that? Even if there was no vacancy, still ARR would have been lower than expected rent only. So this ARR being less than expected rent is not due to vacancy. Means whichever is higher between these two will be taken as gross annual value. Earlier we have taken whichever is lower between these two. Why was that? Because it was falling under exceptional category. If there was no vacancy, the ARR would have been 2000, which would have been higher than expected rent. But because of vacancy, ARR was lower than expected rent in that case. So we had to take lower of those two. Then the third case. Once again, municipal value 1000, fair rent 2000. Naturally, we have to take whichever is higher 2000. 2000 and 3000, whichever is lower, that is still 2000. So what is expected rent now? Expected rent is 2000. Fine. ARR is still 1000. Still 1000. Same. But this is lower than expected rent. Question once again comes, same question. Why is it lower? Is it due to vacancy? What would have happened if this property was not vacant? What would have happened? Because the property is vacant for 6 months, the ARR is only 1000. If the property was not vacant, the actual rent received or receivable would have been equal to expected rent, but it would not have been less than expected rent. So now can we say that the property has a ARR of 1000 rupees, which is less than expected rent only due to vacancy? Yes. If there was no vacancy, ARR would not be less than expected rent, it would be equal to expected rent. But our provision says we should take ARR as if ARR is less than expected rent only due to vacancy. So here ARR is less than expected rent only due to vacancy. If there was no vacancy, it would not have been less than expected rent. At least it would have been equal to expected rent. But definitely it would not have been less than expected rent for sure. Which means definitely this property has ARR of 1000 rupees, which is less than expected rent of 2000 rupees only due to vacancy. When it is only due to vacancy, naturally once again, whichever is lower has to be taken as gross annual value. That is the answer for house property 3. Then coming to the question number 3. Once again same logic, but here there is one more added here. Unrealized rent also is there. So be careful in calculations. Observe carefully. House property 1. First, let us take that. Municipal value 1000, fair rent 1500. Naturally, whichever is higher, 1500. 1500 and 1800. So, naturally, whichever is lower, 1500. Okay. We have 1500 as expected rent. Now, actual rent receivable is how much? 2000 minus 50. That is 1950. That is actual rent, not annual rent, actual rent. For how much period? 9 months only, because vacancy is there for 3 months. For 9 months only, actual rent receivable was 2000. Doesn't matter to us. Why? Because anyway, actual rent receivable after deducting the unrealized rent is higher than expected rent. So whichever is higher means 1950 will be taken as gross annual value in this particular case. This is house property 1. What about house property 2? Same logic. 1800 or 1200, 1800. 1800 or 1500, 1500. So expected rent is 1500. Take it. Then 1000 minus 200, actual rent received or receivable is 800. Take it directly. This is okay. Now the question comes, why actual rent receivable is less than expected rent? Is it due to vacancy? Then always we have to find out some imaginary calculation. What if there was no vacancy? What if there was no vacancy? Then actual rent receivable would have been 2000, because for 6 months if you received 1000, for 1 year we would have received 2000. Of course, then also there would have been the same unrealized rent of 200, but still ARR would have been 1800, which would have been higher than expected rent. Now what does it mean? Just because of this vacancy only, ARR is less than expected rent. So naturally whichever is lower has to be taken, since it is falling in exceptional category. So what is the gross annual value? Whichever is lower, which is 800 rupees. Then house property 3. Same story. 1000, 1450, 1450. Whichever is higher. 1450 or 1800, 1450 only. Then that is expected rent. Actual rent received or receivable is how much? 1000 minus 100, that means 900. Okay. This is less than expected rent, that is clear. That does not require any income tax logic. It is evident. It is less. Question is why? Is it due to vacancy or not? We have to check that. How much would have been the ARR if there was no vacancy? Once again, you have to calculate an imaginary calculation. 1000 rupees you received for 8 months. How much you would have received for 12 months? 8 months, how would we know? Because vacancy is 4 months, let out portion is period only is 8 months. So if 1000 is for 8 months, how much would it be for 12 months? It would have been 1500 rupees per annum if the property was not at all vacant. And of course the unrealized rent would have been there then also. That means the ARR would have been 1400 then, which would have been still lower than the expected rent, because expected rent is already 1450. So even if the property was not vacant, even there was no vacancy, still the ARR would have been 1400 only, which would have been even less than expected rent then also. Which means we cannot say the ARR is less than expected rent due to vacancy. No, it is not due to vacancy. Even if the property was not vacant, ARR would have been less than expected rent only. Means exception is not applicable. Means whichever is higher only has to be taken, that is 1450. Then coming to house property 4. 1000, 2200, 2200, 2200, 2500, same 2200. That is expected rent, whichever is lower. Then 1200 is the actual rent for 6 months, minus 200 means really actual rent received or receivable is only 1000. 1200 minus 200 real, that is actual. Actual means actual only. We should not make our own interpretation of that. 1000 rupees is the actual rent received or receivable, which is lower than expected rent, evident. But why? Again, same imagination should happen here. What if the property was not vacant? How much would have been the ARR? If the property was not vacant, the ARR would have been 2400, because 6 months property was vacant. If it was not vacant, it would have got the double rent. Then Also there would have been realized rent, which we don't know, that is always the standard. But then also the ARR would have been equal to the expected rent. It would not be less than expected rent. So now, at least if the property was not vacant, ARR would not have been less than expected rent. Which also means what now? Just because of vacancy only, the ARR is less than expected rent. Otherwise, it would not have been less than expected rent. It would have been equal to expected rent. Would have been. But still, our point is, when such exceptional situation occurs, whichever is lower is taken, which is in this case naturally ARR. That is the calculation for gross annual value under various circumstances. Very important point to be noted for computational purposes. Logic has to be very perfectly applied, not with assumptions or whims and fancies. Then question number 4 is a straightforward calculation question. Calculate the interest on the loan that is allowed as reduction under 24B for the previous year 1920 from the following information. The loan was taken on 1/1/2015. Amount is 10 lakhs rupees, 10% per annum. Construction completed on 18/8/2018. So first of all, always we have to calculate pre-construction period. Pre-construction period first we have to calculate. When would that start? Naturally, when the loan is taken. 1/1/2015 to the 31st March preceding the year of completion of construction. That means 31st March 2018. That is the pre-construction period. So find out how many number of months that is. How many number of months that would be. So 15 completely, just 12 months calendar year, full 2015, 2016 completely, 17 completely, and in 18, 3 months. So 39 months it would have been. Find out the pre-construction interest then naturally. 10 lakhs into 10%, that is per annum. So do the calculation like this. Let us say 10 lakhs into 10%, that is per annum, right? So what we need? Into 1/12, that will give monthly interest. Into how many months? 39 months. That gives us pre-construction interest. How much would that be? Calculate that. 3 lakhs 25,000. 3 lakhs 25,000 is the pre-construction interest. Out of that, how much will be allowed as reduction? Only 1/5. So 1/5 of 3 lakhs 25,000 is 65,000. That is pre-construction interest. And in addition to that, current year's interest will be anyway there, which is 1 lakh. How do we know 1 lakh? That is same. 10 lakhs into 10%. So 1 lakh. So total interest that can be allowed as deduction under section 24B would be 1,65,000. That's all. When nothing is given, don't assume things like self-occupied and all. Even if it is self-occupied, it doesn't matter. But still, the point is, what was asked, that is where we have to just stop the calculation. 1,65,000 is the answer for this question number 4. That is the total amount of interest that can be claimed as reduction under section 24B. So 15, 16, 17 and 3 months of 18 was pre-construction period. For that period, interest was 3,25,000. 1/5 of that is 65,000. Plus 1 lakh rupees post-construction interest related to the previous year is also allowed in this year. So what happened to the 15, 16, 17 previous year, 17, 18 previous year, 18, 19 previous year? You would have claimed 1 lakh, 1 lakh. We don't care. Our job is only to find out deduction for our previous year. Prior to that, what happened to the post-construction interest? We don't need to worry about it. But definitely pre-construction interest, yes. That we have to worry about it. Since 5 years has not passed after the completion of construction, 1/5 of that is still allowed as deduction under 24B. Next question also is similar. Interest on loan taken and how much deduction is allowed under 24B for the previous year 1920 is asked. Loan was taken on 1/4/2015. Construction completed on 17 February 2019. So pre-construction period first. Pre-construction period. Calculate carefully. 1/4/2015. That is the starting point. 2. 31st March. Be careful. Not 2019. It will be 2018 because construction completed in the financial year 18-19. And 31st March prior to that financial year is the end of the pre-construction period. So exactly 15 to 16, 16 to 17, 17 to 18. 3 years, full years is there. So easy to calculate. 8 lakhs into 3 years, right? No need of months and all. Directly we can say 12% per annum. That is per annum. Like that, 3 years is the pre-construction period. 15, 16, 16, 17, 17, 18. So 8 lakhs into 12% into 3 years means how much is that? 2,88,000. When 2,88,000 is the pre-construction interest, deduction allowed on that is only 1/5 of that. That means 57,600. But post-construction period interest, that is current year interest, which is 96,000. Once again, same amount, like 8 lakhs into 12%. So 8 lakhs into 12% was already 96,000. So adding that to the pre-construction interest, total allowed deduction under section 24B in this case, final answer will be 1,53,600 rupees. That is the final answer. 1,53,600 rupees. Okay. That was question number 5. Check your answers whether got the same answers or not. So these are some of the basic questions basically for practice. Can't expect them in exam. Of course, question number 4 and 5 can be very much asked in exam as MCQs. No problem in that. Then question number 6 is a straightforward question where we have to just compute the income from house property directly. So Gauri lets the property on annual rent of 90,000 and that is also the fair rent. And during the previous year, the following expenses are paid by Gauri. So much of details are given, all unnecessary. What is required to calculate is income from house property. Fair rent is also 90,000, annual rent also, actual rent also is 90,000. So gross annual value will be 90,000, definitely. From that, only deduction available is municipal taxes paid. And during the previous year, following expenses are paid by Gauri. So paid is important. How much was that? 30,000. Not only that, municipal taxes paid for the earlier years also will be allowed as deduction because they are allowed on payment basis, not on accrual basis. So 90,000 minus 37,000, 53,000 is net annual value. That's all. Repairs, useless. Ground rent, useless. Lease rent, useless. Fire insurance, useless. Interest on capital borrowed will be definitely useful, of course. That will deduct after deducting the 30% of this net annual value under section 24A. Amount is 15,900. That is 24A. How much is 24B? Directly amount is given. Interest on capital borrowed for construction only. So 25,000. Don't even need to look at any conditions here because the property is a let out property. Any amount of interest is allowed as deduction. So 15,900 if you deduct from that. Also 25,000 if you deduct from that. Final answer will be income from house property 12,100 rupees. That is the final answer. 12,100 rupees is the final answer. Check your answer. That is question number 6. Then question number 7. Jerry owns a house property in Delhi and from the following particulars compute his income from house property. Municipal value 2 lakhs, fair rent 2,52,000. Naturally, whichever is higher has to be taken. That will be compared with standard rent, whichever is lower has to be taken between those two. So the expected rent itself is 2,40,000. Actual rent per month is 23,000 rupees. Actual rent. And no other things are given like vacancy and all. So per month it is 23,000 means per annum how much would that be? 2 lakhs 76,000. Naturally, since it is higher, that will be taken as gross annual value. Expected rent 2,40,000, but actual rent is more. than expected rent. So that itself is taken as gross annual value because it is higher. Deduct. Municipal taxes, 20% of municipal value. This calculation has to be done very carefully. 20% of not 2,60,000, 76,000. That's what people do. You have to calculate 20% on municipal value. So that will not be given in exam. You have to be careful yourselves. 20% of that is 40,000. But he did not pay. He paid only 50% of the tax that is levied. 40,000, 50% of that means 20,000 only he really paid, that means. So real municipal taxes paid only can be given as deduction, which means the net annual value is 2,56,000. 2,56,000 is the net annual value. Blindly just give 30% of that first deduction. 2,56,000 into 30% means 76,800. That is 24A. If there is any 24B, that will be given as deduction also. We have to calculate that. But before that, expenses incurred on repairs, useless. That doesn't matter. Insurance premium, useless. That doesn't matter. So many unnecessary details will be given in the question. We should not even look at them. Those are all useless. But he has given that Jerry borrowed a sum of 10 lakhs rupees at the rate of 10% per annum on 1/4/2016 and construction completed on 31st July 2018. So once again, same thing. We have to do the working notes of interest on borrowed capital, particularly pre-construction period. So what is the pre-construction period here? Pre-construction period is 1/4/2016. You have to clearly write it. To 31st March of some year. Which year? 2018, because construction completed in 18-19. It will be the preceding end of the financial year, preceding the financial year in which the completion of construction happened. So 16-17, 17-18. So exactly 2 full years is the pre-construction period. So easy to calculate. So 10 lakhs into 10% means 1 lakh. 1 lakh into 2 years means 2 lakhs is the pre-construction period interest. But how much can be claimed as deduction? Only 1/5 of that, which means 40,000 can only be claimed as deduction related to pre-construction period interest. But that is not the only interest. He has not mentioned about any repayment of loan and all. So that means current period interest 10 lakhs, 10% will have to be still paid. So 10 lakhs into 10%, once again, post-construction period interest related to the previous year is 1 lakh, which means 1,40,000 is the total amount of interest that can be claimed as deduction under 24B. So 1,40,000, take it here. So once you have deducted those two, what is remaining is the income from house property. So 2,56,000, 30% already reduced to 76,800. Minus 1,40,000, 24B deduction. So 39,200 is the final answer. So for this question, question number 7, 39,200 is the final answer. Check your answer with that. That should be the final answer of income from house property related to Jerry. Whoever you may be. Then there is one more question, question number 8. Arjun commenced construction of residential house exclusively for his residence, a loan amount of 5 lakhs, 10% interest on 1/11/2017. Finding that there was an overrun in the cost of construction, he raised a further loan of 8 lakhs at the same rate of interest on 1/10/2018. What is the interest allowable under section 24, assuming the construction completed by 31st March 2020? So there are 2 loans. It's okay. We calculate 2 interests. Loan number 1. First loan, what was that? Taken when pre-construction period starts 1/11/2017 to, this is loan number 1, 31st March 2019. Why? Once again, even though the construction completed on the last day of the year also, we have to take the end of the year, financial year, immediately preceding the financial year in which the construction is complete. So definitely what we have to take there is 31st March 2019 as the end of pre-construction period. How many months you can calculate? So November, December, January, February, March 2018. That's all. 17 to 18. Sorry, 18 only, no, that one, yeah. So now November, December, January, February, March up to 2018. 18 to 19, one full year. So 5 months plus 12 months means 17 months interest is pre-construction in this case. And how much was that? Multiply 17 into 5 lakhs is the loan amount. Multiply with 10%, but that was per annum. And we did months here. So naturally we have to do 1 by 12. How much will be that? Do the math. 5 lakhs into 10% per annum. So monthly it will be whatever divided by 12 into 17 months like that. So how much will that be? 70833. $70,833. That is the interest related to loan number 1. That is pre-construction only. 70,833. So 5 lakhs into 10% into 17 by 12. 70,833. That is about loan number 1. Now let us talk about loan number 2. Okay, what is this loan number 2? Loan number 2, when he has taken 8 lakhs rupees, he has taken another loan. This is completely different loan at the same rate of interest on 1/10/2018. So here the pre-construction period starts from 1/10/2018 and of course it ends on the same date because property got completed on 31st March 2020. The pre-construction period ends on 31st March 2019. That is same. But how much is the amount or number of months in this case? Pre-construction period, how many months is there? October, November, December, January, February, March. That's all. Only 6 months is there. Amount is now 8 lakhs. So take the amount of loan first. 8 lakhs. Multiplied with rate of interest is said same rate, which means 10% only. But that was for full year, but we need only for 6 months. So 6 by 12 is enough. So 8 lakhs into 10%, 80,000 by 2. You can say 40,000 is the pre-construction interest here. But these two things put together will get only 1/5 of the deduction. So 40,000 plus 70,833, 1,10,833 divided by 5 is the only deduction that is related to pre-construction period. So I'm writing above it. So how much is going to be the pre-construction period interest here? 70833 plus 40,000 divided by 5. That comes to 22,167 plus post-construction interest anyway will be there, which is straightforward. 5 lakhs into 10% means what? 50,000 straight away. And 8 lakhs into 10% means what? 80,000 straight away. That is post-construction interest. Because nothing has been mentioned about repayment of the loan, entire loan is deemed to be outstanding and full year interest related to the previous year 1920 shall be allowed as deduction as post-construction interest. So 50,000 plus 80,000 plus 22,167. Final answer for this question is 1,52,167. That is the answer for this question. That is the total amount of deduction that Arjun can claim as deduction. Though it is exclusively for his residence, it is okay because the amount of deduction is less than 2 lakhs. So answer is 152,167. That is for question number 8. Then question number 9. From the following particulars furnished by Kiran, compute the income from house property. He owns house property in a metro city. We don't care. Fair value of this property per annum is 27,000. Municipal value is 24,000. So we care about 27,000 because that is higher. House was let out from 1/4/2019 to 31st August 2019. First of all, how many months? April, May, June, July, August. Only 5 months. 5 months. Rent was 2,000 100. That means the real rent is only 10,500. Then onwards, Kiran occupies it for self-residence. We all don't care about it. It is as good as let-out property. It is as good as let-out property only, no difference. Because partly self-occupied, partly let-out, because due to time here, not space. So, even if property is let-out for one day also, it is let-out property. It is not called as a self-occupied property. Though he occupied it for a portion of the year, that doesn't matter. But what matters? Computation matters. So, what was the expected rent here for us? 27,000, which was higher. What was the actual rent received or receivable? Which was 10,500 only. 10,500 was the actual rent received or receivable. Because April, May, June, July, August, 5 months, 2,100 means 10,500. Actual rent received or receivable is lower than expected rent. But is it due to vacancy? No, it is not due to vacancy. It is because he himself occupied it. If it was due to vacancy only, then ARR will be taken as gross annual value. Otherwise, whichever is higher only will be taken as gross annual value. So naturally, what is the gross annual value here? 27,000. That is the gross annual value of this property. From that, you deduct the municipal taxes, which are incurred and paid also. So 4,000 can be very well claimed as deduction. Don't do proportionate things and all for time-based self-occupation. That is only for space-based self-occupation. This is where people mess the things up. 27,000 minus 4,000, 23,000. This is not different from any let-out property. It is same as let-out property. So don't even think about self-occupation. That is just a, actually speaking, unnecessary fact. It is a let-out property. And gross annual value 27,000. Whereas municipal taxes paid are 4,000. And as we know, fire insurance, land revenue, repairs, all of them are useless. Those are irrelevant. Then net annual value is 23,000. That is okay. On that 30% straight away give it as deduction 6,900. That is 24A deduction. Also, interest paid on the borrowing for construction for the year is 21,600. Already he is telling proportionate interest. Proportionate. Already means 1/5 only he has given. Proportionate interest itself is 12,960. So total you can take 12,960 plus 21,600. 34,560 is the deduction under 24B. No problem. Income from house property can be negative. It is negative in this case. Let it be negative. How much is the income from house property in this case? 18,460. Negative. You have to write it in bracket. So that is the income from house property here for this SSC, who is the Kiran. 18,460 is the final answer for question number 9. That's it. Then question number 10. Once again, this is related to just calculating the gross annual value. We know this is the owner of 3 houses which are all let out and covered by Rent Control Act, and from the following particulars find out gross annual value. Same process we have to follow. This was an exam question, by the way. These type of questions can very well be expected for 3 to 4 marks or 5 marks sometimes. So municipal value 30,000, annual rent. See, the words are important. It is annual rent, not actual rent. That is annual rent. Anyway, first of all, according to our convenience, whatever is given, we have to convert it to our requirement. So we have to look at municipal value first, 30,000, fair rent 36,000, whichever is higher. So 36,000. That should be compared with standard rent, whichever is lower. So what is expected rent here is 30,000. That is expected rent. Keep it aside. Then we have actual rent received or receivable. Annual rent is 42,000. Not actual rent, annual rent. And annual rent is 42,000 and there is a period of vacancy of 1 month. Means how much would be the actual rent for 11 months? It will be 38,500 only. But there is an unrealized rent of 7,000, which means 31,500 is the actual rent received or receivable. And naturally, because this is higher, actual rent received or receivable itself will become gross annual value. So the answer is 31,500. That's it. That is a house 1. So we have to look at the period of vacancy and unrealized rent also carefully. And the rent given here, this is an important point. In the earlier questions, it was actual rent. Here it is annual rent. So annually 42,000 means 11 months. How much would that be? That would be 38,500 only. 11 by 12. But there is unrealized rent of 7,000 that can be deducted. So actual rent received or receivable is 31,500. That is higher than expected rents. Hence, that is the answer. Next, house number 2. Municipal value 26,000, fair rent 28,000, whichever is higher. 28,000 standard rent, whichever is lower. So we have expected rent of 28,000. Keep it aside. Then we have annual rent 36,000 and there is a vacancy of 2 months. Once again, annual rent 36,000, vacancy of 2 months means how much will be the actual rent for the period let out? Only 30,000, because 10 months only let out, 2 months vacant. Annual rent 36,000 means monthly 3,000, so 10 months means 30,000 is the actual rent receivable. But in that 9,000 is unrealized rent. So 21,000 is actual rent received or receivable. That first we have to calculate. The logic whether it is lower because of vacancy or not, that all comes later. First of all, we calculate actual rent received or receivable. That is 21,000. Now the question comes, is it less than expected rent due to vacancy? For that, once again, you have to do an imaginary calculation. So what if there was no vacancy? What if there was no vacancy? Then the actual rent received or receivable would have been 36,000 minus 9,000 means 27,000 only. Means what? Even if there was no vacancy also, the actual rent received or receivable would have been less than expected rent only. So we cannot say the ARR is less than expected rent due to vacancy. That means it is not an exception. That means whichever is higher only will be the gross annual value, which means 28,000 is the answer for second scenario. That is house number 2. Then house number 3, municipal value 35, fair rent 30, whichever is higher, so 35, 35 or 36, whichever is lower, so 35. So once again, 35,000 is the expected rent. Okay, no problem. Keep it aside. Then we have annual rent 30,000. When annual rent is 30,000, property was vacant for 3 months. So that 30,000 was for 12 months. How many months the property was vacant, given on rent? Only for 9 months. So 22,500 will be the actual rent receivable. From the 2,500, if you deduct, 20,000 is the actual rent received or receivable in this case. So 30,000 is annual rent for 12 months. 9 months it would have been 22,500. Then unrealized rent 2,500 if you reduce, the real rent, actual rent received or receivable will be only 20,000. It is also less than expected rent. But once again, why? Is it due to vacancy? No, it is not due to vacancy. Very evident. Why? Because annual rent itself is less than expected rent. Even after deduction of unrealized rent also, it would be 27,500. That would have been lower than expected rent even without vacancy also. Which means once again, exception is not applicable. Whichever is higher itself becomes gross annual value. That means 35,000 is the final answer for this question, that is house number 3. That's all. These are the answers for various questions. Very, very important to find out gross annual value correctly, important to calculate the pre-construction period interest correctly, and computation of deduction available under 24B is the most important calculation. These are the only 2 calculations in fact in this entire chapter. If these 2 are done and practiced well, this chapter, all the problems that will be given in the exam we can solve accurately. Of course, the kind of problems might differ, the situations might differ from case to case. That's okay. Now, moving on to the other situation where what if the property is co-owned property? If the property is a co-owned property, then what? There is nothing. If it is co-owned property, split it. No, what is the big deal in that? There is no speciality in this case. If at all the property is co-owned, all that we need to do is we just have to split the items between them according to their share. That's all. So if the property is owned by 2 or more persons whose shares are definite and ascertainable, then the income from such property cannot be taxed as income of an association of persons. If the shares are definite and ascertainable, if we know exactly how much share goes to each of the co-owners, we should consider as if these are two different individuals and we should share the property's worth to each of the co-owners. So there is no speciality in that. All the other things will be determined in accordance with the same logic of what we already know, sections 22 to 25, as part of his individual assessment. That is part of the individual assessment only. But what if the shares are not determinable? No problem. We will not determine as individual assessment. That will be treated as AOP. That is association of persons, assessment of which we don't do. We do only individuals assessment. So for us, what is the only point to be noted? We have to split the calculations between two people. That's all. But main point here is, one and only important point to note here is, where the house property owned by the co-owners is self-occupied by each of the co-owners, then naturally the annual value of such property will be nil as usual. There is no speciality in that. But main point here to note is, each co-owner shall be eligible for a deduction of 30,000 or 2 lakhs as the case may be. That is the only point to be specially remembered in the co-ownership situation. Other than that, it's all just arithmetic. Split between two owners according to their share. If the property is in the ratio of 2:1, we'll do the calculations and split them in 2:1. If he says equally, we split it equally. So nothing special in that. But main point is, when a property which is co-owned also is self-occupied, each co-owner will get a deduction. So this deduction of 30,000 or 2 lakhs, as the case may be, is not for the property. It is for the individual, the SSE himself. So if there are two people, co-owners, both of them will get 2 lakhs rupees deduction on the interest on borrowed capital. So co-ownership definitely gives a bit of benefit. If there are two owners for the same property with a ascertainable split of their share, each of the owners shall be entitled to 2 lakhs rupees or 30,000 rupees under 24B, as the case may be. That's it. Of course, aggregate amount of deduction cannot exceed 30,000 and 2 lakhs, that we know individually. For individual, let us say the co-owner has a interest on borrowed capital related to this property 1,50,000, and he has another property also called as self-occupied. There also he has an interest on borrowed capital of another 1 lakh. Can he claim 2,50,000? No. Entire deduction for one person that can be maximum claimed for one property, two properties, any number of properties. Total aggregate deduction that can be claimed in respect of interest is restricted to 2 lakhs or 30,000, as the case may be. That's it. So that is the co-ownership related to income from house property when same property is owned by two or more different people. That's all. Look at an example here. Illustration 11. Miss Aparna co-owns a residential house property in Calcutta along with her sister Miss Dimple, where her sister's family resides. Okay, who resides there and all, we don't care. Both of them have equal share in the property and the same is used by them for self-occupation. Okay, both are using it for self-occupation. Interest is payable in respect of loan of 50 lakhs rupees at the rate of 10% taken on 1/4/2018 for the acquisition of such property. In addition, Aparna owns a flat in Pune in which she and her parents reside. She has taken a loan of 3 lakhs rupees at the rate of 12% per annum on 1/10/2018 for repairs of the flat. See, each of the details are important. Repairs restricted to 30,000 only. I have to remember that. Compute the deduction which could be available to Aparna and Dimple under section 24B. Deduction only is asking actually. So let us look at Dimple first because she has only one property. 50 lakhs rupees, 10% means 5 lakhs rupees is the interest, right? Pre-construction and all is not there, not given particularly because when the property got constructed and all is not given. Anyway, if it is given also, the year itself is 2018-19. That could be the 1 year interest only. Doesn't matter. Don't worry about pre-construction interest if it is not required. If it is given, then yes. Only post-construction interest is there. That is 5 lakhs rupees naturally. 50% of that for Dimple will be 2,50,000. But can she claim 2,50,000? Not possible. Not possible. So she has to claim a maximum of 2 lakhs only. So that is about Dimple. So Dimple has a share of 2,50,000 in the interest, 50 lakhs into 10%, half of that 2,50,000 restricted to 2 lakhs only. So how much maximum deduction she can claim is 2 lakhs only. Same way. What about Aparna? She also has a share of 2,50,000 in the interest. Yes. In addition to that, she has a 3 lakhs into 12%, 36,000 interest paid for repairs, which is again restricted to 30,000. Yes. Total comes to 2,30,000. Yes, but still again it is restricted to 2 lakhs only. So how much amount can be claimed as deduction by Aparna? 2 lakhs. How much can be claimed by Dimple also is 2 lakhs only. So that is subject to the maximum limits prescribed by law under section 24B. Anyway, with that we can conclude the computational aspects of this chapter. We will also solve some more questions related to co-ownership first before we quickly go through the deemed ownership theory provisions. Look at question number 1 in the exercises. That is Mr. Raman is a co-owner of house property along with his brother holding equal share in the property. Municipal value is given, fair rent is given, standard rent is given, rent received is given. Loan for construction of the property is jointly taken and interest charged by the bank is 25,000 rupees, out of which 21,000 has been paid. See, most of the people will take 21,000 as deduction. Unnecessary information. Nobody said interest has to be paid, not required. So what has to be taken? 25,000 only, not payment. Municipal taxes are allowed as deduction on payment basis. Interest is not allowed as deduction on payment basis. It is allowed on accrual basis only. So 25,000 charged by bank is allowed as deduction, no problem. And one more point, interest on unpaid interest is 450. That is not allowed as deduction. That 450 we should not give as deduction. Definitely no. That is a very clear provision. Disallowance. Interest on unpaid interest is not allowed as deduction. To repay this loan, Raman and his brother have taken a fresh loan and interest charged on that loan is 5,000. Yes, that is also allowed as deduction. Loan taken to repay old loan and interest is paid on the fresh loan is allowed as deduction. So total deduction of interest can be how much here? 25 plus 5. That is 30,000. Next, municipal taxes of 5,100 rupees have been paid by tenant. So should we take it? No, because municipal taxes are allowed as deduction only when they are paid by the owner, not by tenant. So 5,100 we have to ignore. That's it. Compute the income chargeable in the hands of Mr. Raman for the assessment year 2021. So there is no logic of doing half of every case. So rather we can just do one short calculation and then divide it by 2. That is easier. So what is the gross annual value of this property? First let us calculate. Municipal value 1,60,000, fair rent 1,50,000, whichever is higher, 1,60,000. 1,60,000 and 1,70,000, whichever is lower. So 1,60,000. So expected rent is 1,60,000. Rent received is 15,000 per month, that is. So 1,80,000 is the rent received, which is higher. So naturally the gross annual value will be 1,80,000. That is not for Raman only. That is for the entire property. We'll split it at the end. We don't need to do item by item split. That doesn't make sense and not required also. So 1,80,000 is the gross annual value of the property. Municipal taxes deduction not allowed. Clearly you have to write it in a note also. Why? Because the taxes are paid by tenant. No deduction. So net annual value is also 1,80,000. From that 24A is available. So 1,80,000 into 30% means how much? 54,000 can be claimed as deduction under 24A. How much can be claimed as deduction under 24B? Only these two, 25,000 and 5,000. 450 cannot be claimed. and the amount paid is irrelevant. So 30,000 can be claimed as deduction. That is put together, joint loan only. So for both of them put together, this is the amount of deduction, 54 and 30. So once we have these all taken out, how much is the income from house property for both of the brothers put together is 96,000. But we want what? Only for Raman, how much will that be? Okay, half of that. Half of that will be how much? 48,000. That is the answer. So final answer is 48,000. That is the amount of income from house property taxable in the hands of Raman. That's it. That is the question number 1, co-ownership. It's nothing special. All calculations are same. Only thing is we have to just split it at the end better rather than doing it 100 times. All these areas we just do once, that is easy. So 48,000 is the final answer for income from house property of Mr. Raman. That is a co-ownership situation. Question number 2 we have already done. And question number 3 also we have done already. Question number 4. Yeah, this is examination question. Mrs. Rohini Ravi, a citizen of USA, is a resident and ordinarily resident in India. Say she is citizen of whichever country, we don't care. When she is ROR, global income is taxable in India. That we should know already. She is ROR. And she owns a house property at Los Angeles, USA, which is used as her residence. So that is a self-occupied property. Annual value of this house is $20,000 annual value, and value of each dollar may be taken as 65 rupees. So first of all, just take a rough estimate of 25,000 into 20,000 into 65. How much is the value there? 13 lakhs rupees is the annual value of this property in Indian rupees, 13 lakhs rupees. So that is already given annual value of the US property, and that is self-occupied because she is using it for residence. Further, she says the ownership and possession of a flat in Chennai has been taken by her on 1/7/2019 during the previous year, which is used also for self-occupation while she is in India. The flat was used by her for 7 months only during the year ended 31st March 2020. Municipal valuation is 32,000 per month and the fair rent is 4,20,000 per annum. She paid the following to the Corporation of Chennai: property tax and sewerage tax. All of them are useless actually. Why? Because she can have 2 properties in India, because self-occupied property, here there are 2 properties, one in Los Angeles, one in Chennai. So both the properties can be taken as annual value nil only. So municipal taxes again do not matter, municipal valuation, everything do not matter, doesn't matter, since anyway those are self-occupied houses. But what matters definitely is this: she has taken a loan from a bank, and interest on the loan is like this. Period prior to 1/4/2019. Prior to 1/4/2019 means when was the post-construction period starting, or pre-construction period ends definitely 31st March 2019, because construction or possession happened on 1/7/2019. Prior to 1/4/2019 definitely is a pre-construction period interest. So 49,000 divided by 5. 49,000 divided by 5 will be how much? 9840. That is pre-construction interest. 9840. So 9840 is there already. And post-construction interest during the previous year is anyway given. It doesn't matter. We don't have to split it. So 9840 plus 50,800 plus 131,300. All of them, if you add 131,300 plus 9840 plus 50,800, total comes to 1,91,940. Pre-construction interest 9840 plus these 2 post-construction interests anyway. Total 191,940. She can claim as deduction because it did not exceed 2 lakhs rupees. That's it. And in addition to this, she had a house property at Bangalore. She had, not now, and which was sold in March only. But in respect of this, she received a arrears of rent of 60,000 in March 2020, which is our previous year. Earlier, this amount has not been charged to tax. So now it should be taxed under 25A. So 60,000 definitely is deemed to be the income of the SASI, even though she is not the owner of the property, but subject to a 30% deduction under 25A. So after deduction of 30% from that, 42,000 will be positive income from this Bangalore property. So what about Los Angeles property? Answer is 0, nil, because no interest and nothing is there. What about Chennai property? Answer is negative 191,940, because that is the interest allowed as deduction. Then what about Bangalore property? 42,000. So ultimately, how much is the final answer? 191,940 minus plus 42,000. Final answer is negative 1,49,940. 149,940 is the final answer. Negative, that is income from house property of Mrs. Rohini Ravi for the previous year 1920. So that is the final answer. That is a loss, 1,49,940. That is the answer for question number 4. Then question number 5 is also related to a co-ownership. Let us look at this situation. Question number 5. Two brothers, Arun and Bimal, are co-owners of house property with equal share. Equal. Property was constructed during the year long back. Before 1499, we can say. Definitely. The property consists of 8 identical units and it is situated in Cochin. Where is it situated? We don't care. During the financial year 1920, each co-owner occupied 1 unit for residence. Balance of 6 units were let out at a rent of 12,000 per month per unit. So this is important point here. Totally there are how many units? 8 units are there. That is the total. Unit could be a portion, whatever you can call it. In that, 6 are let out. 1 is occupied by Arun. Another one is occupied by his brother Bimal. So this is the way the property is already there. But Arun and Bimal, definitely they can claim those one property, what they occupied them as self-occupied. There is no problem. Each portion is a separate property here. But these 6 properties are let out. 6 units are 6 different properties, as good as at 12,000 per month per unit, per portion you can say, that is per unit. Municipal value of the property is 9 lakhs rupees, that is the entire property. Municipal taxes are 20% of municipal value which are paid during the year. Other expenses are as follows: useless, repairs useless, insurance premium useless. But what is definitely useful? That is interest payable on the loan taken for construction of the house, 3 lakhs. Yes, that can be claimed as reduction. But story is not over. One of the let out units remained vacant for 4 months during the previous year. So rent received or receivable is not fully for all the 6 properties. For 5 properties, they are fully let out throughout the previous year. So 5 into 12 into 5 properties, 12 months into each month, 12,000 rupees. That is the rent receivable from those 5 properties. But the other property was not let out for 12 months. It was vacant for 4 months. Means 8 months only the rent would have been received. So how much would be the rent that, first of all, these 6 properties would have fetched during this year? That we should calculate. So 5 into 12 into 12,000, 7,20,000. 8 into 12,000. 96,000. Total is 8,16,000. 8,16,000. That is the actual rent received or receivable after the one property being vacant. Then Arun could not occupy his unit for 6 months as he was transferred to Chennai and he does not own any other house. Doesn't matter, even though it is considered as self-occupied only. Self-occupied or unoccupied, both are self-occupied. Other income of Mr. Arun and Bimal are 2,90,000 and 1,80,000 respectively for the financial year. These are other incomes, not income from house property. Point is, compute the income under the head income from house property and also the total income of the two brothers for the assessment year 2021. Two brothers is what is asked. First, let us take these two house properties out of the equation. That is related to the self-occupied portions. See, when there is a self-occupied portion, how many portions are self-occupied totally? Two portions are self-occupied. Two portions. Anyway, we'll split them into equal shares later, so no problem. So, how much will be the portion of Arun or Bimal? You can do it separately also, jointly also. Self-occupied portion of Arun, let us say, and self-occupied portion of Bimal. Net annual value will be 0, gross annual value, municipal taxes, everything will be useless. And finally, interest on borrowed capital only will be there in both cases. How much will be that? So this 3 lakhs rupees is for 8 units. How much will be for 1 unit? That is 37,500 for A, Arun. But this property was constructed during 98-99, before 1499. That is also important point. So 37,500 will not be claimed as reduction. Not possible. It has to be restricted to 30,000 only. Though it is calculation wise 37,500. Self-occupied portion, amount of deduction that is available is only self-occupied portion 30,000 only. Both of them will be able to get 30,000 each. Each 30,000. A will also get 30,000. B will also get 30,000 deduction out of this 3 lakhs. Though, technically speaking, that is related to two properties, which is should be 75,000, but it's restricted to 60,000 in total. Now look at the other let out portion first. Let out portion, what we have to look at? Municipal value is given. Municipal valuation is how much? 9 lakhs for the entire property. Let out properties are only 6. So 9 lakhs into 6 by 8 means how much? 6 lakhs 75,000 is the municipal value. 6 lakhs 75,000 is the municipal valuation. That is the expected rent, because there is no fair rent that is given, no standard rent is given. So expected rent is 6 lakhs 75,000. But what is the actual rent received or receivable? Already we calculated 8 lakhs 16,000. So what will be gross annual value? Whichever is higher naturally. So 8 lakhs 16,000 itself will become gross annual value. So 8 lakhs 16,000 if you take as gross annual value for the let out portion, combined thing. From that, deduct municipal taxes. Again, be careful, only related to let out portions. How many of them? How many of them are there? 6 of them are let out. So how much is the municipal tax first of all? 9 lakhs into 20% of municipal value is municipal taxes. Into 6 by 8 only will be allowed as reduction. So 9 lakhs into 20% into 6 by 8 only will be allowed as reduction. 6 by 8 means only 6 properties out of 8 which are let out. So 1,35,000 has to be claimed as reduction under municipal taxes. Then what is net annual value? How much is net annual value? 816 minus 135 will give us 6 lakhs 81,000. Okay. Then give 30% deduction under 24A. That comes to 2,04,300. So 681,000 minus 30% deduction is how much will be the remaining? No need to do this actually, but just for computation purposes, 4,76,700. This is 24A. Then 24B comes. 24B, 3 lakhs rupees is the interest. 3 lakhs, that is for entire property, 8 units. 6 units will be how much? 2,25,000. No problem. For let out portion, no limit. 2,25,000 can very well be claimed as reduction. No problem there. Let out portions, no limit at all. So 476,700 minus 225,000 will be 251,700. Now divided by 2. So naturally each of them will get how much? 1,580. 125,850 is the share of each of them, which is coming from let out portion as income from house property. But earlier 30,000 they can claim as reduction for the self-occupied portion. By the way, that was negative. So 30,000 if you reduce from it, Both of them can claim that. So how much will be the income from house property net after setting off both loss and profit? 95850. 95850. That is the income from house property that is chargeable to tax in each case, because they are having equal share. You can calculate first and then give to equal share to each of them. 95850 is the answer. Add the other incomes to that. So you will get the total income of Arun. Add 1,80,000 to that. You will get the total income of Bimal. That is not a big deal. That can be done later. But main point is, how much can be claimed as deduction here under 24B for self-occupied property? That date has to be clearly remembered, because of which 30,000 only is the restriction. And finally, the income from house property is 95850. That is the answer for the exercise question number 5. Each of them will get 95850 income from house property taxable. Other incomes, you just add it, you get total income. That's not a big deal. That anybody can do. Main thing is income from house property. So this is also important question, examination question, which was given in the exams earlier. These are some of the practice questions which we have done already, and I would strongly suggest to test your knowledge by going through these MCQs also. Those are there already. So all that you need to do is just mark them with your answers. First write 1, 2, 3, 4, how many MCQs are there, write the numbers. Say 10 MCQs are there, don't look at answers. 11, 12, yeah, 12 MCQs are there. Write the number. This also you can take like a task. Write the number, write your answer, read them carefully and write your answer, and then check with the answer that is already given in the essay material and see if there is any mistake. Why there is a mistake, rectify that mistake and identify these answers are obtained by you or not. So this is a practice that you have to do related to MCQs. Once you are thorough with all the provisions, this should not be a big deal. But prior to doing all these things, practice things, you have to be thorough with the provisions. So revise the provisions well, summarize them, all of them in a paper. One paper also is more than enough for this actual entire head of income. After doing that, practice the questions which are already discussed once again on your own, on paper. Then also do the MCQs given at the end of the essay material. That will give sufficient practice for this particular head of income. And some more questions related to this head of income. Anyway, I'll give you as separate task, which you can also use for further practice. That's it. With that, we can conclude this chapter of income from house property. And sorry, I think this deemed income or deemed ownership is one topic that we have not discussed yet. That is just a theoretical discussion. You can also just generally go through them, but ideally if a theory question comes on that, what is deemed ownership, you have to write the headings at least. Why deemed ownership first of all should be there? Though there is no legal ownership in his name, the person is considered or deemed to be the owner of the property. So these all deemed ownership provisions are contained in section 27. First one is transfer to a spouse. If at all the house property is transferred by an individual to his or her spouse otherwise than for adequate consideration, means without adequate consideration, then transferor is deemed to be the owner of that property. So legally, A may transfer a property to his wife, let us say B. Legally the property is in the name of B, but still in the eyes of law, B is not the owner. A is deemed to be the owner, not according to any other law, by the way, only according to Income Tax Act. According to section 27 of the Income Tax Act, though legally the property is transferred by the SSC to his or her spouse, if that transfer happened without adequate consideration, then the transfer is deemed by the law as good as not a transfer. So the transferor is deemed to be the owner of that property. But there is an exception here. What if there is a transfer happening to spouse in connection with an agreement to live apart? If they are divorced or they have agreed to live apart, then this deeming provision does not apply. Then who will be the owner of the property? Transferee only will be the owner of the property. That's it. That is when transfer of a property to the spouse without adequate consideration. Of course, what is adequate? All these things, we don't have to worry about them. There is a special discussion on all these things in the chapter of clubbing of incomes. But still, adequate is what law has mentioned. What is adequate has to be a judgment that has to be exercised by the assessing officer also. That also matters. But yes, one court case is there. One person said that he got adequate consideration in the form of love and affection from his spouse or wife. So question came, can love and affection be considered as adequate consideration in the eyes of law? That was the case. Answer is no. Love and affection is not an adequate consideration. So when we say consideration here, we are talking only money, no sentiments, no attachments, no love and affection is going to be considered as adequate consideration. So if a person transfers the property to his or her wife or husband, as the case may be, we can call it as a spouse in general, then if such transfer happens without adequate consideration, that transfer in the eyes of income tax law is as good as null and void. So the law continues to deem the transferor to be the owner of the property, though legally the property is registered with the transferee. That is the point here to be noted. That's it. Same logic applies to second case, where the transfer happens to a minor child. Then also, once again, why somebody is transferring property to the minor child? Just to divert the income, that's all, to avoid tax. And if any property is transferred to the minor child, once again same, otherwise than for adequate consideration, then transferor shall be deemed to be the owner of the property transferred. That's it. And there is an exception here also. This is an exception, you have to remember this, important even in the case of clubbing. That is a minor married daughter. Exception means what? In that case, if a person transfers a property to a minor married daughter, then who will be the owner of the property? Minor married daughter herself will be the owner of the property. Here it is gender specific, only daughter, by the way. Spouse is not gender specific. Spouse is possible to be used in the context of husband also, wife also. Daughter is daughter only. So particularly female, that is minor married daughter. If the transfer happens to a minor married daughter and a parent of the minor married daughter transfers a property to her, then she herself will be the owner of the property. The provision of deeming the ownership for transferor does not apply. That's it. Right? So that is the point here to be noted. Minor married daughter is an exception. So naturally another question comes, sir, how can a minor be married? Is it illegal or not? Of course, sir. That is the Indian Penal Code which will take care of it. We don't have to worry about the legalities of the law. Law said this is the situation. That's all. Is it illegal under any other law? Is none of our business. If it is illegal under any other law, which it is, marrying a minor girl will be definitely punishable by law, but the other laws will take care of it. That doesn't matter to Income Tax Act. So we are not here to enforce the Indian Penal Code or any other provisions of other acts. Simply, if the transfer happens to a minor child normally for inadequate consideration, then transferor is deemed to be the owner. Exception to that rule is minor married daughter. That's all. Same way, there are some other exceptions, like practically not much useful also, but they are not going to be applied also anywhere by us. Like for example, a holder of an impartial estate. Certain estates will be there huge, they are not divisible legally. They are so impartial that they are all so huge. Big zamindars and all, they will have those impartial estates. So the SASI, if he is owner of the impartial estate, he is deemed to be the individual owner of all properties comprised in that estate. So if that estate comprises of, let us say, 400 shops, and all of that is belonging to one guy, which is actually originally an old fort. I am talking a real life example. There is one fort in one of the villages, where the fort now is almost converted into the shops, and that whoever the owner of that fort, small fort, must be old zamindar somebody, he gets rent from all those shops. But the point is that is not divisible. It is so same type of property. So the point is, legally he may not have registration for all these shops. What is the proof that he is the owner of each of the shops? No, it is not. No need also. As far as income tax is concerned, if there is an impartible estate which cannot be divisible, each property is deemed to be already in the ownership of the holder of that impartible estate. That's all. We don't need to go into the details of Hindu Succession Act and all that. Not required. Those are mostly the civil matters, legal matters. Property related things are mostly legal matters, highly complicated and highly litigating matters in the real life. We don't need to go into that. Our job is only, if at all a question comes, what is deemed ownership? A question came already also. Question was like this: ownership is everything in order to attract section 22. Agree or disagree? That's it. That was a question, 4 marks question. No, it is not true. Why? Because what is ownership? According to 22 charging section, the SASI should be owner of the property, and 25A is an exception to that. Even though SASI is not owner of the property, still he can get attracted to the tax liability. Even though he is not legally the owner of the property, under section 27, he can be still deemed to be the owner of the property. And those are the cases we are looking at. Transfer to spouse, transfer to a minor child without adequate consideration, holder of an impartial estate, member of a cooperative society. This also happens a lot of times. It so happens that some colonies will be developed, journalist colony, film nagar, like that. Individually, the properties will not be registered in the name of the person. It will be registered only in the name of the society as a whole. But does it mean the society itself is owner of that? No. The individual person is deemed to be the owner of the property. Deemed. Though it is not registered in their name, but it is just allotted to them by way of the cooperative society, which is related to some housing cooperative society or association, whatever the name you call it. Then legal ownership may not be with that person. Still, since it is allotted to that person, it is deemed that he is the owner of such property if he is a member of such housing cooperative society. And another thing is, persons who are in the possession of the property are also deemed to be in the ownership of the property. What type of possession of the property? Where there is a part performance of the contract. And of course, we don't need to go to the Transfer of Property Act and all, 53A and all. But the point is, possession is taken by the buyer, sale consideration is paid or promised to be paid, some advance is made, but sale deed is not executed. It is not, let us say, registered. So what the person will say? No, it is not registered in my name, so I am not the owner, he will tell. Income Tax Act says, no, Baba, doesn't matter. If you are in the possession of the property, there is no need that it has to be really executed, or no need that it has to be registered. So the legal ownership is immaterial. Beneficial ownership, really who is the one having possession of the property, that matters. So that is another case where also Income Tax Act is deeming the person who may not be the legal owner still to be the owner for the purpose of this head of income. Legally somebody else is the owner in all these cases. That is why we are deeming. Otherwise, what is the point of deeming? We are deeming because SC may not have really the legal ownership of the property, but still he is deemed to be the owner of the property in the cases mentioned in section 27. Transfer to a spouse, minor child, holder of impartial estate, member of a cooperative society, having a part performance of the contract and possession of the property. And not only that, a person having a right in the property for not less than 12 years. Let us say if a person has taken a lease of a building for a period of not less than 12 years. Not less than 12 years means more than 12 years. That means lessee is deemed to be the owner of the property. This is a very dangerous thing, because he is after all a person who is a tenant. But if the lease is more than for a period of 12 years, then the lessee, the tenant, will be deemed to be the owner of the property. That is why practically nobody in India writes a lease deed for more than 12 years. Once a person has a lease deed of more than 12 years, almost even from the other law's perspective also, he can assume that he is the owner of the property. So this is a practical issue, also legal issue also. For us anyway, we don't have to go into the details of them once again, because these are highly litigation things. Only point is, if anybody has a right to be within the property by way of a lease of not less than 12 years. So at a time, if somebody can enter into a lease agreement for more than 12 years, as good as the lessee becomes the owner of the property. But that is not what Income Tax Act is telling. Legally he is not the owner. He is deemed to be the owner of the property for this purpose only. That's all. Only this purpose. So what happens normally is, usually what happens, that they give the lease, let us say, yearly like that. So each year extension they will do. Then the lessee will not be deemed to be the owner. So the doubt may come, but there are so many people who are doing business since 40, 50 years in the same building. Are they deemed to be owners? No, they are not. Because their lease deed is not going to be for more than 12 years. They will extend it every year. So each year they will write a new lease deed. That is why, because legal things are known to many owners in this country, nobody in this country will write a lease deed of more than 12 years. If he does that, he is doing at his own risk, because he is giving away his ownership rights to somebody who can be called as a tenant practically, but legally he will be deemed to be the owner. So dangerous thing in that sense. So no problem. Practically, nobody will give a lease of more than 12 years in general. If it is given, you can consider that lease is just a sham, and it is basically the transfer of property. The lessee or the tenant will be the owner of the property in that case. So these are the 6 cases where there is deemed ownership under section 27. Theory question, very important, definitely yes. But you have to write at least 2-3 lines about each of them. Transfer to spouse, transfer to a minor child, holder of imperishable estate, and member of a cooperative society where he got allotted a property, and a person who is in possession of the property because of the part performance of the contract under 53A of the Transfer of Property Act. Though the registration has not happened, still he is deemed to be the owner. And the person who has taken a lease of a property for more than 12 years at a time, that person will be deemed to be owner of the property. That's all. With that, we can conclude this chapter conclusively and comprehensively, and we will discuss another head of income in the upcoming sessions. Till then, take care. Bye-bye. Thank you very much.